Welcome to our show. Every week we bring you the best in tactical analysis, trading tips, and interviews with top traders and industry experts. And if you stick around to the end, every week we give away something of value. So make sure to watch till the end. Today is no different. We're talking risk models, which is one of my favorite topics. Let me start off by saying that risk isn't a number, it's a mindset. On this Tactical Tuesday, we're going to break down risk per trade models that protect your capital and let your winners run. If you haven't watched our videos on top before, there's usually a few things that we cover. First is an intro where I present the topic. Then, we have a hook that's sort of like the thesis of the video, and finally a CTA or call to action. So if you can't watch the entire video, at least watch the hook and the CTA because those will be the most important parts. So without further ado, let's jump into it. Let's start with our hook. Risk isn't a number, it's the soul of survival. When I first started trading, I used to risk a fixed amount per trade, usually $20, $50, sometimes even $100. This was before I had developed any real skill, and I was just using random lagging indicators to generate signals. It's not a very good strategy, and I lost money doing that. When I started to learn more about trading, I started to develop rules and strategies, and they were starting to work better. But I still risked the same amount per trade. If I won, great. If I lost, meh, it hurt a little bit, but it wasn't really a big deal. Eventually, I learned something important. Risking the same amount on every single trade isn't optimal. There are two common ways that traders handle their risk. They either risk a fixed dollar amount per trade, or they risk a percentage of their total account equity on each trade. Both methods have pros and cons. Let's start with risking a fixed dollar amount. You may be thinking, hey, this is simple. I make X dollars per trade, then I'll risk X dollars. For example, let's say I'm risking $50 per trade. I'd buy 50 shares of Tesla and put my stop loss below the swing low. In this case, it would be $697.50. That means that if Tesla falls to that price, I'll lose $50. So I'd have to adjust the position size based on the price of the stock. This can become complicated quickly, especially during volatile times when prices are moving fast. A lot of traders will use a position sizing calculator to help them determine the appropriate share size so they don't accidentally overexpose themselves. Now let's talk about the pros and cons of risking a fixed dollar amount per trade. The pros are that it's relatively simple. All you need to do is look at the current price of the stock and plug it into a position sizing calculator. The con is that it's not very scalable. What do I mean by that? Let's say I have two accounts, one with $1,000 and another with $10,000. If I risk $50 on every single trade on both accounts, the $50 represents a much higher percentage of my smaller account than it does my larger account. So I should probably risk a lower amount on my smaller account. If you've ever traded a paper account, you know what I'm talking about. The solution is to risk a percentage of your account instead. If you risk 1% of your account on every single trade, then you're always risking the same amount relative to your account size. So if you have $10,000 in your account, you're risking $100 on each trade. If you have $100,000 in your account, you're also risking $100 on each trade. Here's the formula to calculate 1% of your account. Multiply your total equity by 0.01. Now you'll know how much you should risk on each individual trade. Now let's go through some examples of position sizing using percentages. For this example, we'll use the stock NVDA. Here's a list of recent trade entries, their stop prices, and profit targets. Let's go through each entry and calculate the position size needed to risk 1% of my account on each trade. For the first entry at $246.85, I'll buy 100 shares and place my stop loss below the previous swing low at $237.95. If I'm wrong about the direction of the trade and Nvidia falls to that price, I'll lose $100, which is 1% of my account. This method works perfectly for stocks that are above $100 per share. But what if we're trading options? Options are priced in dollars and cents, so you can't simply buy whole contracts. For example, let's say I wanted to buy $100 worth of Apple December calls. I could buy 0.05 contracts and risk $50. Or I could buy 0.1 contracts and risk $10. In this case, I'll choose to buy 0.1 contracts of the $165 strike calls and risk $10 per trade. This means that I'll buy 0.1 contracts and place my stop loss at break-even. Alright, now that we understand the two main methods for handling risk, let's move on to our second point, how to track your risk. When you're managing your own money, you need to keep track of your risk to make sure that you're staying within certain parameters. You can use a simple spreadsheet to do this, but there are also other tools available to help you out. My top picks are either MyfxBook or TraderView. MyfxBook is a free tool that helps you keep track of your trades, whether they're winning or losing. Once you enter all of your trades, you can see your overall profit and loss, average win rate, and the amount of time that each trade took. TraderView is a similar tool that's paid, but it offers more features such as alerts and live account monitoring. The reason why I like these tools so much is because they automate a lot of the work for you. Instead of having to keep track of your wins and losses manually, you just connect your trading platform to these tools and they'll automatically calculate everything for you. Now let's look at an example spreadsheet that you can use to track your risk. I'm assuming that you're already keeping track of your trades in a similar fashion. This spreadsheet just adds a few extra columns that will help you determine your average loss per trade, your average win per trade, and your win rate. You can fill in all the information for each individual trade, including the trade setup, the entry and exit points, and whether or not you had a winning trade. Once you have all of this information filled out, you can see your average loss per trade, your average win per trade, and your win rate. And that brings us to our CTA. Now let's jump into the Q and a portion of the video. I'm going to answer questions that you guys have sent in on social media and on our website. What's the biggest mistake you made in your first year of trading? I was overly mechanical. I tried to turn trading into a job rather than a craft. The market is constantly changing and evolving, so you have to be able to adapt. How do you balance risk management with letting your winners run? I use a trailing stop loss so that if a trade starts to move against me, I'll trail my stop loss to lock in some profits. This way, I'm able to let my winners run while still managing my risk. What's the best advice you can give to someone who's just starting out? Learn from other people. Don't try to reinvent the wheel. There's no need to spend years learning everything on your own when you can learn from others who have already made the mistakes. Thank you so much for watching. Please like and subscribe. Check out our channel for more great content. And we'll see you next week on a new episode of Trade Tactic Tuesday.